gotta leave your money behind you. Raise your hand to
Welcome back to another episode of Gimme Some Truth, International Edition, *𝗟𝗜𝗡𝗡 la verdad, *ďme la vérité, as it's also known. Before we get into our topic today, which is talking a little bit more about the global markets for 2022, kind of building on our guide to the markets that we publish every year, our 2022 guide to the markets. And if you haven't gotten the PDF copy of that, feel free to go to our website, either at 𝗟𝗚𝗡𝗡𝗡.com or usexpatinvesting.com. But before we get to that, I'm sitting next to a man with a coffee cup that says USMNT Stan, Syan Farmer on my right, and Syl Michelin on my left. Stan, we've addressed the second part of that. The first part of it, U.S. men's national team soccer team.
Yes.
They play El Salvador tonight.
They do.
At 6 p.m. This is Thursday that we're recording this podcast, January 25th, 26th?
It's the 27th, buddy.
27th. But it's the day where you are when you're listening to this podcast, because it's really the information is timeless. U.S. El Salvador tonight, on a scale of 1 to 10, how confident are you? And did you lose sleep last night?
You know, I woke up probably at 5, which is probably half an hour to an hour earlier than usual, depending on how mad at my snooze I am. But so, yeah, I did lose a little sleep. And I would be extremely confident just based on talent, but talent doesn't decide World Cup matches, as we know. The qualifiers are a battle. And since we drew El Salvador 0-0 last time, it'd be hard to be ultra confident. But everything about this match and how qualifiers have gone since that initial World Cup qualification match in September would indicate that the U.S. should win this. I'm going to predict 3-1.
And so your confidence 1 to 10 is 7?
I'm a 7. Yeah.
Very good. Very good. We also have a crossover guest, Syl, I guess from you were on our Global Guide to the Markets podcast that focused more on U.S. markets, domestic markets. And one of the things that you guys talked a lot about and that we'll hopefully move away from, but it'll be hard to avoid for maybe reasons you can talk about, is the U.S. Federal Reserve and interest rates.
Yeah, it's hard to not talk about it. And that's why I picked it as a topic, is because it's probably the single most important factor affecting markets in the U.S. and globally. Is what is the Federal Reserve doing? What's its policy? And how is it changing? And 2022 is going to be an interesting year because it is the beginning of a shift in U.S. monetary policy, where we're moving in a direction where the Federal Reserve is tightening its monetary policy after years of incredibly loose, easy money, market-friendly type policies, right? So it was really interesting for that reason.
I think you could say that the markets are in flux, like Syl's microphone seems to be in flux right now.
and so, related to that, for people who might be a little nervous about how things are coming into the year, why does this have the effect that it does on the markets, raising interest rates right now?
Well, the market is, to a great extent, addicted, for lack of a better term, addicted to these easy money policies that have been in place for many, many years. And I apologize again if my voice is sounding a little strange. We have Dan here trying to fix it. Low interest rates are very positive for equity markets in general, in particular for more growth-oriented type stocks, and I wrote about it in the 2021 Outlook. So, and obviously the S&P 500 and most of the main U.S. indices are now dominated by growth stocks, stocks that really benefit from that low interest rate environment. And for the last 10 years, the Federal Reserve has been able to keep its policy stance very, very accommodative and market friendly because there was no risk to inflation, right? There was no real pressure on prices, and that has changed in 2021. And now it's in a position where it has to act. There is no choice. They cannot really delay it. And we've seen the market reaction to what's been really just hints of, a tighter policy so far. And we are already seeing a very significant shift in market performance. So, and that's why I called the article "Impossible Choices," is because you have this impossible choice between being market friendly and keeping that growth stock momentum going, so to speak, with easy monetary policy and controlling inflation, right? So two very conflicting objectives and a difficult balance to find.
And one thing I'll say is, we saw this a couple years ago. I think it was called a taper tantrum when Powell and the Fed, raised interest rates a couple years ago. And this isn't, to my mind, any cause for panic. It's a natural response in terms of revaluing stock and earnings growth. One of the things that goes into one of the fundamental calculations for financial advisors and stock valuers, analysts, and so on, is the idea of discounted future cash flows, right? Mm-hmm. And the discount rate is the Fed 10-year Treasury. And as that goes up, that's, if I can get 4% in a bond, a very safe U.S. government bond, I'm going to expect larger growth from the firms in order to value, accept that kind of valuation going forward, for a stock. And so if I'm only getting 1% from the bond, I'll accept 4% growth. Whereas if the bond is earning 4%, I'll only accept 7% growth. So it's really a recalibration in some sense as well of valuing the markets properly. Stan, you were around in the taper tantrum, but back then, and we see it. It kind of it's one of those things as well. So a little bit where the U.S. Catches a cold or gets a sneeze and the rest of the world catches a cold. But related to that, one of the things that we've seen as well, and Syl mentioned it, inflation. The rest of the world is also starting to see inflation. The EU, which Syl expressed some surprise at. The UK is seeing some inflation, and so what does that mean, big picture for investors? This kind of global inflation that we're seeing.
Well, I mean, I think that first and foremost, let's remember, let's go back to post Great Recession, and the worries in Europe was always deflation, right, or disinflation, or some kind of negative, increase in relative prices, and how that was, a stymie to economic growth and prosperity, right? So, all of the, it's a mirror, right? You can, whatever the Fed is doing is going to influence what the ECB does. It's going to influence what the Japan Central Bank does. This will influence what the Bank of England does, because everything's interconnected now. Right, the market for labor is global, right? We wouldn't have an Expat podcast if there weren't people moving around the world, and sometimes that's for job opportunities. So I mean, it's all interconnected, and maybe inflation is not as bad in Europe as it is here, right? Just like maybe COVID's not as bad, in certain countries in Europe as it is in Wisconsin, right? But, do we have to worry about, these things when they break out in the United States? Do we have to worry about this phenomenon elsewhere? Of course, right? And it's naturally going to flow. As far as, in my mind, COVID created all kinds of dislocations of capital and disrupted supply chains and so on. So everybody who's anybody in the economics biz, predicted that this could, result in inflation. And anytime you have helicopter money coming out of the central banks and the governments with all the fiscal stimulus, and in this country that meant, direct checks to just about every family in the United States, right? It's going to cause inflation, right? That money is going to find a home. We were drowning in liquidity. And now think about this as the Fed is taking some very moderate steps to reduce some of that liquidity before we entirely drown in that liquidity, right? And we get runaway or hyperinflation. So if you don't like inflation, it's not fair to say, well, inflation's terrible, and then say, well, wait, why is the Fed doing this? They're affecting my stock returns, right? Think of this as was alluded to before. We were on a liquidity reduction program under this chairman back in 2019, and then COVID got in the way and disrupted that, and we had to be ultra accommodative again, right? Well, it's time to start, turning the spigot and tightening up a little bit again, because, by and large, economically, we're no longer in lockdown mode, and COVID is still here, but we're learning how to live with it, and inflation has. Back then it was, not really even a concern when we started the last tightening cycle before the COVID disruption. Now inflation is clearly here, right? But don't think that, think of the Fed as doing their best to make sure that doesn't get out of control. So in terms of your portfolio, think of this as a normalization period. Think of the incredible gains that bonds, largely enjoyed throughout post-Great Recession and for 2 decades before that, but that's, a larger topic. Think of the incredible gains that the stock market has, realized off of the COVID lows of March of 2020, and realize that those gains had to be borrowing a little bit off of the gains that you get down the line, right? And corrections are very normal. And, frankly, I think we could have gotten a pretty appreciable correction like we have here in January without the central bank whispering a word, right? Because it's just been kind of overdue. But I really see this as, in the bigger picture, this is what central banks are supposed to do, and we really have to take the long view of this and maybe adjust how we're invested, maybe pay some attention to the interest rate risk in our portfolios.
Well, I think as well, that was going to be my kind of follow-up question.
Yeah.
Syl, Stan, people ask, okay, and or worry about inflation, and they say, well, what are we doing about inflation? What are we doing about this? And do we need to make major changes because inflation is coming? And one of the things that I always want to remind people is, if we have longer term inflation, stocks are a longer term inflation hedge. Because remember, if I sell a Hershey bar for $1 today and the price inflates, I'm going to sell it, for $1.05 next year, and that will be reflected on my balance sheet, and I'll make a little bit money, and you'll see it, reflected in the stock price. But there are specific chunks of the portfolio as well as invested, Syl, that we have, clients set up for that they can, that there's some sort of flexibility there. I think of emerging markets, for instance.
Sure, and I think you give a great example of, how stocks protect against inflation, right, is having that ability to pass on price increases, right? So you want to own companies that have the ability to raise the price of goods that they sell and pass on that cost to the customer instead of having their margin squeezed. So, and that's why in an inflationary environment, value tends to do better. We would move back into an environment where the quality of earnings matters again.
Or just earnings matter.
Yeah, just earnings themselves
What?
matter.
They matter.
Companies have to make money.
Exactly, right? So we kind of lost sight of that, but it might start to matter again. And also to Keith's point about what are we doing about inflation? I mean, it's important to keep in mind that the risk of inflation is really ingrained in every aspect of our investment thinking. So it's not like 2 years ago we were investing as if inflation was never going to be a factor again. A big part of why we invest our clients' capital the way we invest it is because we know that one of the great threats to investors over the long term is inflation, right? It's probably
it's up there in the pantheon of risk, right? And as you get older and you move into retirement, Social Security adjusts for inflation, but like your IRA doesn't automatically adjust for inflation.
Yeah, you can't.
So we need to be growing that to keep up with inflation.
You
right?
can't. Yeah, you can't. Age 65, take your money out and sit there and with all of your cash and just spend it down, because that $40,000 today in 30 years, even with 1.5-2% inflation, becomes $80,000 a year. But specifically in the portfolio as well, Syl, what other beyond quality, beyond because we invest clients not just in growth stocks but also value. We've talked a little bit too in our portfolio meetings at how we can tax efficiently give a value tilt. But what are some other things in the portfolio that the reason I mention emerging markets is those are commodity dependent, and we have a lot of clients who we've put in kind of an alt sleeve for that reason as well, right?
Sure. I think emerging markets, and there's different stories within emerging markets, and obviously a story that has dominated recently has been China, right? And so that has hurt emerging market as a whole. But in general, I still think emerging markets are a good place to be, even in a higher inflation environment. The way a lot of emerging markets make money is by borrowing dollars and selling commodities, right? So if you think about that positioning, they benefit from a weaker dollar and from higher prices in raw material and goods in general.
Oh, absolutely.
So there's something obvious there.
They may not drive Teslas in Latin America as much, right? But Tesla's relying on lithium that is produced in mining in Latin America heavily, right? And
Latin America is probably the best example if you're trying to play a theme that generally is a weaker dollar. And when we talk about inflation, a lot of inflation is weaker currencies fundamentally, right?
Right.
So if you're trying to play that theme, South America is an obvious fit in terms of the countries that borrow dollars and just sell goods.
Well, and now we get into another kind of topic here, and we're running up against. But will the dollar weaken? Because what we've seen is actually over the last little bit, the dollar strengthening. The only place we can look at the whole basket. I think of the UK as the one currency where maybe the dollar hasn't strengthened as much against. And that's because, again, we get back to central banks and who's raising interest rates. Well, if Powell, and we see that tightening, the EU has said, well, we're not going to raise interest rates this year quite yet.
Yeah.
The US has, announced, probably in March we're going to start. Predictions have gone to, I would say if you're in predictions, the over under is 3.5 right now in interest rate hikes in the United States. If the Eurozone doesn't raise interest rates, that leads then to a stronger dollar. What is that? What might that mean? Why might that help the rest of the world?
Well, I mean, it depends what you value the dollar against, right? And it's true that there's been this race to the bottom in terms of central banks around the world, a race to, be as competitive as possible and therefore, in some ways, depreciate their currencies. So if you compare the dollar to the euro, it's strengthened. If you compare the dollar to oil, it's not done so well.
Right. That's a good point. I'd also say, look, I mean, every other central bank is eventually going to have to, follow the Fed's lead here. So I wouldn't necessarily make a prediction that we're going to have a stronger dollar in 2022. It's nothing in terms of what currencies are going to do is something I safely want to go on a podcast record as making the ultimate prediction on.
But and I think to just return to that, one thing I always tell my clients is if I could predict what the currencies are going to do in the short term, I wouldn't be talking to you. I'd be sitting on an island somewhere. But I wanted to if inflation comes in the U.S. and it's greater than the rest of the world, that leads to a weaker dollar. But there also is a scenario that we could see where we have a stronger dollar in 2022. So wanted to talk about that. I think as this final conversation kind of points out here, there's a lot more for us to talk about. Feel free to reach out to your advisors and talk about this. It's kind of a very interesting time in the markets because there are a lot of pressures, as Syl, you mentioned. So we're here to chat, and hopefully this has provided a little bit of clarity about what we're seeing and going forward. So thanks again for listening to Ďme la vérité, Dame la verdad. I'm going to have to learn some other languages to add this in.
You can do Canadian. Give me some truth, buddy.
Now we've successfully offended an entire country once again. Yeah. It wouldn't be our podcast.
I'm sorry. I'm getting ready for the USMNT Saturday match against Canada.
Yeah. No maple syrup this weekend for Stan's pancakes. Thanks for listening, and thanks for listening to Give Me Some Truth.
𝗟𝗚𝗡𝗡𝗏 Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of 𝗟𝗚𝗡𝗏 Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit 𝗟𝗚𝗡𝗏.com.